Hi guys, welcome back to another video. Today I'll be showing case this Reit, which is the typical example of currency impact that you will see in other Reits sooner or later. For this Reit, the currency impact is much worse and faster because they only have one property in Singapore while the rest of the properties are in other countries, which is sadly not the US. So any properties in other countries will definitely suffer due to weaker currency, therefore bring in lower income when they are converted to SGD. So let's dive right into their property portfolios. So with 105 properties, like I mentioned just now, only one is in Singapore, whereas as you can see, the rest are in UK, Netherlands, Germany and Australia, with majority in Australia. Moreover, they also separate into different categories such as the logistics and the office and business parks, which we'll elaborate more later. As you know, currencies of these countries have recently dropped in a lot of in currency strength. So because of this, their dividend and distributable income has been impacted. So one example is the Aussie dollar, which has dropped from an average of 1:1 last year to 1:1.10 this year. So let me give you an example to show you the impact. So let's take 1 million of Aussie revenue for example. So if last year, since the ratio is 1:1, the amount of SGD that the Reits receive from all these different properties would be converted to SGD and given to us as distribution as 1 million as well, because it's 1:1. However, for this year, because of the ratio drop, the 1 million in Aussie has now been required to be divided by 1.1. So when you take 1 million divided by 1.1 converted to SGD will be 909,000. So you are losing out on 91k just from 1 million. So imagine the impact when it is 10 million, it will be even higher subsequently. Therefore, this shows the importance for REITs to hedge their currency, but they can only do so for a certain period of time, for like maybe 6 months or 1 year. However, if it drags on, their hedges would definitely be less favorable or less impactful because the currency strength is permanently stationed at a lower strength as compared to SGD, therefore permanently decreasing the amount of income or opportunity that the REIT can get for shareholders. So let's look at the key highlights. So as you can see, for the key highlights, obviously the DPU has dropped by 0.8% year over year to 7.62 SGD, whereas the net asset value increased by 4.8%, while the aggregate leverage dropped by 1.8% to a very low value of 27.4%, with a fixed debt rate of 81.7% at an average cost of debt of 1.6%. Okay, so one interesting catch that you can take from these slides is that the management are emphasizing a lot, and I mean a lot, on L&I portfolios. As you can see here, increasing valuation of 425.6% for L&I portfolio, proactively focusing on L&I. So what is L&I? L&I is essentially referring to logistics and industrial, because this REIT now is logistic and commercial, consists of these 3 different categories. So personally, I was invested in Fraser L&I, which is the original form when they first IPO, before they merged together with Fraser Commercial to become Fraser L&C. If you have tend to follow my channel, I tend to favor L&I industries more, as they are always more in demand and favored in the market. So because of this, you can see that they are proactively trying to select investment that is on L&I and portfolio rebalancing by selling away some commercial assets as well. Because of this, they are trying to tell people that they are actually actively increasing the L&I weightage, which is currently increased from 7.2% to 68.3%. So in the later slides, we will see the results of the L&I compared to the commercial, which shows quite a big difference. Okay, so let's break down the key financial highlights of the informations. So firstly, lower revenue and lower MPI due to CSE divestment, which is the Singapore commercial property, and weaker exchange rates. As you can see, the revenue and the MPI dropped compared to last year, dropping respectively of 9.7% and 10.6%. They also reduced in financial costs, mainly due to the interest reduction from the repayments of the loans using the divestment proceeds, which is a good thing but can also be a bad thing because they are paying off their loans of cheaper rates. However, I want everyone to focus on this important part. Okay, if you see the distributable income to unit holders, it has dropped by 0%, whereas the DPU, as you can see, it dropped by 2.8%. So this difference was partially because of exchange rate and the extra units. But you might be thinking, how come the DPU only dropped by 2.8% when the MPI actually dropped by 10.6%? So if you look at this important line here, capital distribution in second half of FY2022, which is now, includes the distribution from divestment gains of 5.35 million. So this is a very big red flag, because this means that even with this contribution, the DPU actually dropped by 2.8%. So if we do some simple back calculation and we take this value, deduct by 5.35 million, you will get 134,295 million. And using this value to back calculate with the number of units, you actually get a DPU of only 3.63%, which is a 6.6 drop in the DPU. If you follow from my previous video when I analyzed Maple Industrial Trust, they also had the same thing where they split their divestment gains into 3/4 of separating to mitigate the drop in the distribution. So this is a very normal strategy that a lot of REITs use, and you have to take note of, because the media headlines do not really tell you that much information, and you must do your homework to read it up to make sure you know the full impact of the interest rates and the currencies hitting on the REIT itself. Okay, so similarly for these slides, it shows the comparison for the full year 2022 comparing to 2021, where it's the same thing, where the revenue and NPI drops while the distributable income increase, but the DPU drops as well. So this was partially due to capital distribution gains of divestment gains throughout the year of 8.21%. So one big red flag that I want to highlight is that, as you can see here, policy to hedge distribution on rolling 6 months basis to manage forex volatility on income. However, as I mentioned just now, currencies that permanently or stay weaker in the long run will definitely impact the REIT, especially for Fraser L&C, as they have majorities of their properties overseas. So one example is, like I mentioned previously, Aussie dollar, where 2021 average was about 1:1, while this year currently is at 1:11. Similarly for euros dropped from 1.6 to 1.1 to 1.42 this year. So all this weakening impact in the long run would still impact on the REIT, although REITs actually mentions that they would hedge the currency. Okay, so looking at the debt portfolio for Fraser L&C, I've mentioned before that it's always my favorite, partially because the average leverage is very low with a very low cost of borrowing at 27.4% and 1.6% respectively. Moreover, their ICR ratio is way higher than a typical REIT of 13x, with a good rating of BB+, which means that taking loans is not of an issue. However, as you can see from the FY2023 and 2024, they would have a bunch of debts here that are required to be refinanced. So because of this, I expect the cost of borrowing to increase subsequently for the 2 years. So this is something that you have to take note for the subsequent years. And the interest rate impact for the REITs distribution, and observing whether is there any change in the value as well. So for the rest of the loans, I would not be too concerned as of now, because I'm confident that in the long run the interest rate will go down over time. Another good green flag is that with such a low leverage ratio, they are very safe in able to purchase new properties of L&I that they have been focusing on. So in the event if the economy is in a recession, they will be able to buy properties at a cheaper price or at a discount, giving shareholders more value. Okay, so let us look at the portfolio valuation, and these slides will actually tell you the difference between the performance of L&I as compared to commercial properties within the REIT itself. As you can see from these slides of logistics and properties, they actually consist of Australia, Germany and Dutch, and UK properties. If you see one thing in common, all of them are having an increase in the valuation itself. However, for commercial properties, if you see of the Australian 4 properties, 1 Singapore and 3 UK properties, they also have a very common thing, is that their valuation actually dropped. As you can see here, although it's a slight value, it's not a good thing to see properties drop in valuation as compared to increasing. So similarly for the leasing as well, as you can see, reversion for logistics and industrials are actually going back up or recovering at 4.1%. But for commercial, they have leasings that are decreasing. So this means that new leases are coming in at a cheaper value because it is harder to find customers. So for the well lease, which is WALE of the customers, it's not of a very big concern, because as you can see for the next 2 years, majority are actually based on L&I, and I'm confident that for L&I base, there's definitely no issue in renewing. Okay, so looking at the performance of the occupancy between the logistic and industrial side and the commercial side, you can see that there is actually a difference where the L&I is 100%, which is very good, whereas compared to the commercial side, which is a decent value of 91.2%. As you can see from the different occupancy in the commercial throughout the countries. One good thing is that Central Park in Australia actually increased in a decent amount of 9%, and there is a slight decrease in the UK occupancy and in both of the UK occupancies, but it's not a big concern since the drop is quite minor as compared to the increase. So at an average rate of 91.2% is actually a good value. There is also a lot of key acquisitions that is coming in, where there is 4 extra L&Is and 1 commercial property. So this is a good thing, where next year we will expect more income to come in, because this is expected to complete in first quarter, is completed in first half, second half of 2023, although this is not stated, should be next year, and also a commercial property in Australia. One good thing is that with overseas properties, it most probably comes with freehold, so we don't have to worry about the land lease as compared to Singapore, where there's no freeholds, and land lease are expected to be done by the management with the government to increase the land lease. So the management actually also shows the different portfolio of tenants sector breakdown between L&I and commercial, where they actually mentioned that 61.6% is coming from L&I tenants. And for me, L&I is always in demand and doing well. So because of this, tenants tend to be more stable and have a lower chance of delisting or breaking down, thus having the risk of losing income. And you can see that 83.2% of the GRI with exposure to government-linked cores, resilient industries attract new economic sectors. So this is referring essentially to L&I sectors and government-linked companies. So because of this, 83.2% of the income is actually quite stable, which is a good thing, but we should always take this as a pinch of salt because this is for management, and sometimes REITs they do slides in order to make it look nice so that it sells to shareholders to support them. So because of this, please do extra readings, and I hope that my video actually gives you some good insights into the recent results. Okay, thank you so much for watching. If you have stayed till the end of the video, you are amazing, and I really appreciate that you spend your time listening and watching through my content. I hope that it helps, and please do more research before actually doing your investment through your hard-earned money. Please like, subscribe, and support my channel, and comment on anything that you would like me to talk about or how I can improve further to make it more entertaining or more informative as well. Thank you, and to the next video.